World Bank kind of does what it was always supposed to do. The World Trade Organization is bigger and more powerful, but it does what it was supposed to do. The one that's changed the most is the International Monetary Fund, because we don't need swing loans for deficit problems anymore. You just devalue your currency. But they do make loans, usually that are highly political, highly selective, and they do kind of work around the edges of global financial crises, but that really falls back on the Fed and the other central banks. So we're still in an age. Okay, let's unpack that a little bit. I'll answer all that, but you got 4 or 5 moving parts. So let me just kind of highlight them a little bit so we can address them separately. The dollar generally does rally in a financial panic. That's correct. And it does so because people want the best assets they can find. They're like, the best description I've ever heard of a financial panic is everybody wants his money back. It doesn't matter what you're in, get me out, sell it, whatever. I want dollars. Well, when you get the dollars, you got to go buy something. So you can leave it in the bank, but banks are risky. I mean, the problem in 2008 is the banks were failing, and that didn't quite happen in 2020, but it absolutely happened in 2008. So they buy treasury bills. They buy treasury notes. They're the safest assets. They may not want them for long, but you can buy a 2-year treasury note or a 6-month treasury bill. You're not in it that long, and your money's safe. So there is a demand for dollars somewhere around the world to buy that. Not exactly what's going on today, but it's related. We're not in a global financial panic right now. We may be heading for one. We talked about that separately. We're not in one right now. We are in a recession. It looks the U.S. is definitely in a recession right now. We had 2 consecutive quarters of decline in GDP, first quarter, second quarter. Well, that's a recession. We'll see what the third quarter is going to be, but it may be prolonged. It may get worse. Europe is in a recession, based on the latest data. Japan is in a recession. China looks like they're in a recession. They reported their most recent growth figures of 0.4% for the second quarter, not 4%, but 0.4%, versus compound growth of over 10% negative. So we're really looking at a global recession. Now, a recession or even a depression, which it may turn into, is not the same as a financial panic. You can have panics without recessions. We saw that in 1998, 1987. You can have recessions without panics. We saw that in 1990 and 2020. Sometimes they do go together. 2008 was an example of both, a severe recession and a severe financial panic. But I would keep those separate, because if we're not in a global financial panic, then we don't necessarily have dollar buying because of get me out of everything else. Although I want to come back to that. But we are in a recession. Now, the recession should damp down the inflation. It hasn't yet. Inflation's high. There's no question about it. We see it in the data. You see it at the gas pump. You see it at the store. But that may trend a lot lower very quickly, but not for good reasons. In other words, you say, well, what's the Fed doing about inflation? Well, they really can't do anything about it. The inflation is coming from the supply side. The inflation can come from probably a lot of places, but 2 places in particular: supply side and the demand side. Supply side inflation is when there are shortages, there are bottlenecks, there's supply chain dysfunction. People run out of stuff. There's not enough fertilizer, not enough water, not enough A to make item B. So you got to shut down assembly line because you can't get, titanium from Russia to build Boeing aircraft. It's complex. It's huge. It's the subject of my next book, Sold Out, which is coming out in November. But supply chains are breaking down in many different respects, and prices go up as a result. But that's not. But the other kind of inflation is called, and that's called cost push inflation. The other kind of inflation is demand pull inflation. This is when consumers change their behavior. They get it in their heads like, hey, prices are going up. They're getting out of control. I better go out and buy that thing, And this is what we lived through in the 1970s. And I remember very well. If you were going to buy a refrigerator, a new car, a dishwasher, whatever, you'd say to yourself, I better go buy it today, because if I wait 3 months, it's going to be higher. Or 6 months, it's going to be a lot higher. So of course, that just pulls demand forward. and it creates excess demand relative to supply, and then prices do go up and it feeds on itself. Next thing you know, bosses are handing out raises because of inflation, and people just spend more, et cetera. So the Fed can do something about demand pull inflation. They can destroy demand by raising interest rates, raising mortgage rates, credit card rates, and everything else. They can't do anything about supply inflation, the supply chain inflation, cost push inflation. They can't do anything about it. The Fed doesn't drill for oil. The Fed doesn't drive a truck. The Fed doesn't run a cargo line. The Fed doesn't mine, titanium in Russia. They can't do anything about any of those things. So, then the Fed can't do anything about it. Two, it will probably run its own course in the sense that, if prices go higher, there's going to be a lot less discretionary income. You still got to put gas in your car, and you still got to put food on the table. If those two things have doubled in price, and they have, then you have that much less left over for everything else. You'll say, well, I'm going to skip the vacation, skip the concert, skip the restaurant, skip a lot of things, new furniture, whatever. I'm not going to buy any of those things because all my money is going to buy gas and food. So you still get the gas and food, but not more. You just pay more, and the value of your dollar goes down. Real wages go down, and you're not spending money on anything else. That'll put the economy in a recession real fast. That's happening. We're in a recession. I already said that, but it will get worse. Now, here comes the Fed, right? Always a day late and a dollar short, or maybe too many dollars, but they always get it wrong, is my point. So what are they doing? Well, they're saying inflation in the numbers. They don't really seem to distinguish between supply side and demand side. And they're going to the Volcker playbook. Raise rates, raise them. Cost of a much worse recession, higher unemployment, business failures, people out of work. I say, who cares what the price of gas is if you're sitting home unemployed? Because you're not buying any gas. So that's one way to get gas prices to come down, is just stop buying it, because unemployment goes up to 10%. And that's kind of what we're looking at. The idea of a soft landing, forget it, not even close. The evidence is already there. Now, let's get back to the stock market. But even as early as the 1960s, you could see what was happening. In 1950, and just after World War II, beginning of the Bretton Woods era, the United States had 20,000 tons of gold. By 1970, we had 9,000 tons of gold. Where did the 11,000 tons go? Well, the answer is 3,000 to Germany, 2,500 to France, 2,500 to Italy, 600 to Japan, et cetera. And as we had all these trading partners, and the way the system worked at the time, if you ran a trade deficit, that meant you got their stuff. So we were buying transistor radios and Toyota cars and Sony TVs and French wine and taking vacations in Switzerland. But that meant all those dollars were going overseas. And those trading partners who had these dollar surpluses could cash them in for gold. And they did. And we sent them the gold. And that was how the system worked. But by the late 60s, a run on the bank had developed. A couple of things happened. One was there was a private market that was set up side by side with the official market. So the official market was $35 an ounce. The private market, it could be $40 an ounce, $41 an ounce. It wasn't wild. It wasn't $200 an ounce, where it got to sooner than later. But they could cash in dollars for gold at $35 an ounce, turn around and sell the gold in the market for $40 an ounce. That's practically risk-free, and you make an easy profit. And if you want to leverage it, you can make even more. And that was happening, but more to the point, countries were putting the gold in their vaults. There came a time when Charles de Gaulle sent a destroyer to New York to pick up his gold to bring it back to France, but with the under the auspices of the French Navy. So that was exhilarating. So, and it was because there wasn't. Two things were true. One, there was never enough gold. It was all based on confidence. But two, the confidence was eroding because the U.S. ran massive trade deficits and budget deficits, the twin deficits at the same time. Now, there's a case for that. And this was kind of what the Marshall Plan was all about in a much smaller way. But as time went on, at the end of World War II, Germany was in rubble. Japan was in flames and ashes. But they were important economies, and we needed friends to face off against the Soviet Union. So it's very much in our interest to help those countries get back on their feet. Well, how could they do that if they didn't have any money, they didn't have any gold, they didn't have any credit? Well, they did have some. What they really needed was some money and some credit. But you could extend that to them so that they could get manufacturing going, and then they paid it by exporting stuff. So again, around in the 60s, the Volkswagen Beetle was a popular item. Japanese transistor radios took them to the beach, et cetera. And so, but that meant the United States, had to run trade deficits.
Thank you for watching. American attorney, economist, investment banker, speaker, media analyst, and author James G. Rickards specializes on money and precious metals issues. He is the author of 6 more publications in addition to Currency Wars, The Making of the Next Global Crisis. He is a New Hampshire resident. Introducing Addison Wiggin, your host. American author, publisher, and director Addison Wiggin works in these fields. He was the executive publisher and founder of Agora Financial for 18 years. His publications include Financial Reckoning Day, Empire of Debt, The Demise of the Dollar, and The Little Book of the Shrinking Dollar. He is a well-known New York Times best-selling author. The documentary IOUSA, an exposé on the national debt, was written and produced by Addison and was nominated for an Academy Award in 2008. He is presently a Baltimore, Maryland resident. In March 2020, Addison launched the Wiggin Sessions, a venture powered by Consilience Financial.